Ever wondered how the double entry accounting system works? Well, buckle up, because we're about to embark on a journey that will demystify this core accounting technique. Double entry accounting sounds fancy, right? But it's really quite straightforward. It's a system that records both sides of your financial transactions. Think of it like a seesaw, where everything needs to be in balance for it to work properly. Now, every financial transaction you make will impact at least two accounts. For example, if you purchase a fancy new espresso machine for your cafe, it affects your cash account and your equipment account. And all of this revolves around what's known as the basic equation of accounting. Assets equals liabilities plus equity. In simpler terms, what your business owns, that's your assets, is always equal to what your business owes, liabilities, plus your own investment in the business, equity. So that's the basic principle, but how does it work in practice? Well, you'll have to stick around to find out. Well, let's dive into the nuts and bolts of double entry accounting. This system is a bit like a seesaw at the playground. For the seesaw to balance, the weight on both sides needs to be equal. Similarly, in double entry accounting, for every debit, there must be an equal and opposite credit. Now imagine you are buying a shiny new bicycle. You pay for it with cash so you have less money, but hey, you've got a new bike. In accounting terms, we say your cash account is debited, while your bicycle account is credited. If you're feeling adventurous and decide to take out a loan to buy a motorbike instead, your loan account is credited, while your motorbike account is debited. Remember, it's all about balance. Each transaction impacts at least two accounts, maintaining the equilibrium of the accounting equation. Now that we've seen how it works, what are the key points to remember? Double entry accounting might seem complex, but there are a few key points that make it easier to understand. Let's boil it down. At the heart of this system is the concept that every transaction impacts at least two accounts. Picture it like a dance. When one partner moves, the other responds. So, if you purchase a laptop for your business, your cash account decreases, but your asset account, specifically your equipment account, increases. Now, here's the crux of the matter. The total debits and credits must always balance. If they don't, then there's a misstep in your accounting tango. And no one wants that. It's a surefire way to step on your partner's toes. And lastly, the equation assets equals liabilities plus equity must always hold true. This equation is the VIP guest at our accounting party, and it ensures everything stays in harmony. And there you have it, double entry accounting demystified. Remember, it's all about balance.